Hi everyone, I'm Geraldine Sundstrom, Portfolio Manager and Head of Asset Allocation. I'm here with you today to discuss how PIMCO is positioning portfolio across global asset classes, as well as other key takeaways from our year-end asset allocation outlook, Prime Time for Bonds. I'd like to start by providing our overall risk posture in multi-asset portfolio today. Given our outlook for slower growth, inflation, and the potential for a mild recession, we are emphasizing diversification and caution in our portfolio and prioritizing quality. This outlook, along with market valuations and asset class fundamentals, also leads us to strongly favor fixed income in our portfolios. Looking more closely at each asset class, we are neutral on equity, as we believe earnings expectation and elevated valuation will return to more reasonable levels over time. Thematically, we favor high-quality US companies versus European equities. We are also underweight emerging market equities given concerns about Chinese growth outlook. From a sector perspective, we prefer those that may benefit from secular growth and fiscal measures, while we're negative on rate-sensitive industries such as home builders or consumer durables like automakers. Turning to fixed income, we see very attractive opportunities within the asset class. We are overweight high-quality fixed income given high yield, a decelerating inflation, and our view that policy rates are approaching their terminal levels. For bonds in general, the starting yield is a strong predictor of the potential return, and therefore at current levels, high-quality fixed income offers potentially higher returns than equities. We are overweight the United States, European duration, as well as those countries that have structurally a more floating rate mortgage market like Australia, because their economy are more sensitive to higher interest rates. Within credit, we prefer high-quality securitized credit, like agency mortgages, and are underweight the higher-risk corporate sectors, especially in high yield. Within real assets, we do prefer inflation-linked bonds, given attractive real yields. We see the most value in the American TIPS, which offer an attractive way to hedge inflation, given markets are pricing in a fairly modest long-term inflation expectation, and they are therefore very valuable in terms of portfolio construction. Lastly, I wanted to touch upon PIMCO's outlook for foreign exchange going forward. We're neutral to the US dollar. We're balancing more attractive interest rate properties with overvaluation concerns. We are underweight the euro, given expectation for divergent monetary policy paths, as well as a contracting economic activity. We are overweight the Japanese yen as a useful diversifier in portfolio and an alternative to the US dollar, given a cheaper relative valuation. And finally, we are overweight select emerging market currencies that offer attractive valuation profile as well as high real carry.